Hello, everybody. Welcome to Wednesday. The S&P 500 was up about 0.4% today. A lot happened today, actually. It was a pretty big day. There's four main points that I want to make about kind of what was driving today, and I think they're all important even for the future. So, number one, there was after hours, after the market was closed yesterday, there was an announcement that the Treasury Secretary and a few others from the U.S. here were going to meet with China in Switzerland to start the negotiations on the tariffs. So that's really good sign. It's a great thing. Hopefully they get a lot accomplished. And then what happened was Trump came out and said basically, hey, I don't want to reduce the 145% tariffs, especially before we start the negotiations, which is what the Chinese have been asking for. And he says, hey, we have a huge advantage here. As long as these tariffs are here, there's no trade happening and we're not losing anymore. Because he sees the deficit as a loss. So if China sells us more stuff than they buy from us, then they are taking advantage of us. And if we cancel trade altogether, which we've done with this high tariff, we're actually in a better situation. Well, you see all these headlines with 46% of toy companies should be going out of business in the next 2 months because China makes 80% of the toys, and there's so many little headlines like that. These little businesses are going to get hit. So I'm not sure that Trump has the right idea about these trade deficits. He's been really kind of going in the opposite direction of what, is kind of an accepted norm as far as that goes. You get a small country that happens to have cheap labor that, we like their products and we bring those in because they're inexpensive and still useful to us. But they're not big enough to buy back as much, just in terms of the size of the country or the wealth of the country. So we have a deficit, but we're still taking, some advantage of that and getting some inexpensive products coming in that if we tried to make them here in the US because our labor costs are so much higher would be a lot more expensive and the consumers would be able to buy less. So that's the issue with the tariffs. He's trying to basically get rid of these pieces with these trade deficits. And that's actually a really dangerous piece. That should have scared the market more than it did. It did go negative because this is an ongoing thing of, between this weekend where he's talking about basically, in my interpretation, making the tariffs permanent. And then secondly, like today, looking at these tariffs and these blockades and lack of trade as a benefit. And again, all these companies that use this outside sources for their inputs to sell. That's going to be a really tough pill to swallow. And then we had the Federal Reserve Chairman come out. Didn't change rates just like expected. And I thought it was kind of interesting because he could have said, "Hey, we think tariffs are going to really create inflation. We're definitely not lowering rates." Or, "Hey, we think tariffs are really going to create unemployment, so we're going to be lowering rates." He just said, "We don't know." Which is kind of what I've been saying too. Unfortunately, we don't know. It's a double-sided threat. It could actually do both. So tariffs could raise inflation. So we could have, say, 4% inflation at the end of the year instead of the target of 2% that the Fed wants. And we could have 6% unemployment instead of 4%. Both are possible because of tariffs. And that's what he was talking about. And one thing I thought that was very important takeaway from that was just that he talked about waiting to see the hard data. So normally the Federal Reserve is trying to get ahead of the curve a little bit, and they're looking at some of the soft data, some of the surveys that are coming out, and some of the data that is maybe leading data. They're looking for the actual hard data, which means they're going to be late. Again, the market should look at that fairly negatively. The Federal Reserve is saying they're not going to step in until they can see exactly how this is impacting prices and unemployment. And so, that could change if you have a big, event like we had with, the pandemic or with the Lehman Brothers failing. The Federal Reserve will lower rates in those environments. So if some bank failures start or something happens because of the pressure that we're dealing with the tariffs, the Federal Reserve would probably move in on that. However, that was very interesting to see. They're going to wait for the data, and their thought process there was it's better to see the data and know the direction to go, whether it's lowering rates or raising rates, than it is to get in front of it and be wrong and really exaggerate. So in other words, if they start to lower rates and it turns out that employment doesn't get affected that much, but it really rings up inflation, they could get it into a point where things get out of control. I think that's what, people don't seem to realize here. If you look at these big downturns, It's possible for things to just get out of control. It happened in the Great Depression, happened in 2008, et cetera, where things just kind of break and start to cycle, and you get these, high unemployment numbers. We've gotten a lot better with all these stimulus pieces and the ability to kind of bail things out. Um, but again, that's assuming we still have a strong enough dollar, we still have enough, sales of our treasury to be able to, go out and find that money to do these stimulus. So we'll see how that plays out. And so, right at the end of the day, the White House announced that they were redoing the artificial intelligence restrictions. And this was seen as positive by the market right away. We saw Nvidia and some of these other things jump, and the market was maybe down a little bit or just barely up, depending which index you're looking at. And they all ended up a bit more because of that. It was really, I mean, literally the last 20 minutes of the day that this announcement was made. After the market had closed, you look at some of the commentary. There's some thought that it could even be worse than what we have right now. So what we have right now is kind of this two-tiered approach where we can sell to our friends, we can't sell to the other people. And there was some thought that maybe they're talking about going country by country, sort of like with these tariffs and negotiating situations for these AI chips and using them, which would not be a good thing for the AMDs and NVIDIA because it would slow down their, pipeline and their sales process. So again, very light on what that meant. And so unfortunately, what we call job owning. So the Federal Reserve's fairly famous for this. They try to say things to get the markets to go in the way that they want. So, for example, 2022, they wanted the markets to go down because that helped their inflationary fight. They wanted the yields on bonds, to go up, which, helped their inflationary fight. And so they would say things to try to make that happen. But in the end, once the data starts to come, the market's going to react to that data more than the job owning. And we actually saw that with the Federal Reserve, pretty much stopped really responding to what the Federal Reserve was saying eventually, just focused on the data. So we're in that spot right now with this White House where there's a lot of job owning. It has an impact. We talk about, oh, we're going to lower tariffs on China, and the market did really well for a while. And then today, hey, I don't see any reason to because it's better to not do any trade. Those types of things. So but if inflation is, double where it is now and unemployment is, 50% higher than where it is now, the market's going to respond negatively to that, regardless of what the White House says. So we're in this zone right now where we're not seeing the hard data yet because there's a lag between when you stop doing shipments from China or even all of these other tariffs that are happening, happening to the automobile industry and what have you. We haven't seen the true impact of that. That's coming this summer. And it could be mitigated because things could be solved by then and tariffs could be back down to a level that's reasonable, or it could be that we're still in the same spot and still trying to figure out what to do. And of course, at that point in time, you'd have this potential for higher inflation and higher unemployment both at the same time. So anyway, that's what's happening today. I thought today was very interesting. Lots of good things going on, worth definitely looking at and understanding. And I reiterate my desire here to be in a safe spot. Just because there's too many things here and too many misunderstandings about trade deficits and what have you, with people that have the power to kind of really wreak some havoc here if they're not careful. So it's again, the risks don't outweigh the rewards for me here in this particular market, but that could change very rapidly. We'll see what happens, but look forward to talking to you tomorrow. Thank you very much.